Hi everyone, it's Professor Reiko here again today, continuing on with our lessons on the accounting cycle. If you recall our last video, we started our couple-part series into the adjusting journal entries, and we start with deferrals. So remember, deferrals are when the cash comes first, and the revenue or expense is deferred to the end of the period, and that's when we do the adjusting journal entry. That's when we recognized the revenue or expense. When we get here going with accruals, we're going to see they are the opposite of the deferral. So make sure you review that prior lesson if you haven't looked at it already. Here we can see the expense or the revenue comes before the cash. So deferrals, cash comes first, revenue or expense comes second. Here it's the exact opposite. The expense or revenue is recognized first before we receive or pay the cash. All right, so you can see some common examples on the expense side, like salary and wage expense, interest expense, and then on the revenue side, sales or service revenue, and interest revenue as well. So let's just look through a few quick examples here, and then we'll do a longer example here in a couple of videos down the road here. All right, so accrued revenues. All right, so this is the revenue side. So they are revenues. They have not been recorded. Remember, this is all adjusting journal entries, which means we're doing this at the end of the period. It could be at the end of the month, end of the quarter, end of the year, but just end of the accounting period that we're concerned about. So the revenues that have not been recorded, which means we are now going to record that revenue. All right, the adjusting journal entries for accrued revenues is most often a debit to a receivable account and a credit to the related revenue account. All right, so some common examples, like we said, deal with interest. All right, so if we had loaned somebody money and they were going to pay us back 3, 4, or 5 months down the road with the interest of that time, we can still accrue the interest, which means each period we would do the interest receivable for whatever amount it works out to be and record interest revenue. All right, so that is an accrual entry, which means what we're doing here, the important part of accruals, and I can't stress this enough, we want to make sure that the revenue or the expense is recorded in the correct time period. All right, so let's just assume this journal entry here relates to 1 month's worth of interest. All right, well, that 1 month of interest revenue belongs to this current month, and that's why we're recording it in that month. All right. Another, if you think about this journal entry, accounts receivable, sales revenue, you've done that hundreds of times. That's also kind of an accrual. Remember, the cash comes later. So you think about it here. This interest one, we have this receivable, which means they owe us, and when they pay us, that's when we receive the cash. Accounts receivable, they owe us money, and then when they pay us, that's when we receive the cash. So once again, the revenue comes first. We're recording the revenue in the correct time period, and then the cash will come later whenever they pay us. All right, so if we look down here at the bottom on the expense side, I have just an example with some numbers to it. So accrued expenses are basically like accrued revenues. They're expenses that have been incurred, but we have not paid them yet. All right, so the expense has happened, but we haven't paid it yet. So they will always be a debit to an expense account and a credit to a payable account. Because remember, the cash, we're going to pay it later, which means it makes sense to have a payable to it. So looking at this example, we have a company, they pay its salaried employees on the 7th of each month, where the pay is for the previous month's work. So for example, if they work all of January, we will pay them February 7th. If they work all of February, we will pay them March 7th. However, remember the pay that we're going to give them, we want to make sure we record it in the correct time period for which they worked. All right, so if the monthly salary is $15,000, then what is the entry to make at the end of January? All right, so remember, at the end of January, we have not paid them yet, but they have worked an entire month for us. All right, so that means, on basically January 31st, we would just make this journal entry. We would have salary expense and credit salary payable for the $15,000. Once again, as I mentioned above, the main point here is this expense of $15,000 relates to an expense of the company for January. Therefore, we want to make sure we record it in January so it gets recorded in the correct month. Okay, so that expense is now recorded in the correct month. Once again, we see the expense comes before the cash, and then when they pay it, they say they pay on the 7th of every month. So on February 7th, we'll pay them, which means we just take the payable off the books, and we credit cash for the $15,000, and then we repeat that process every single month. All right, so accruals, it's not like there's anything difficult about it, but sometimes students struggle with making these adjusting journal entries. So remember, with accruals, you always want to make sure you have your revenues and expenses recorded in the correct time period. All right, these accrual journal entries help us do that. All right, so our next lesson, what we'll look at is on depreciation. And then after that, we'll do an example where we put all these adjusting journal entries together into one problem. All right, so I hope you enjoyed this. I hope this helped you understand accruals a little bit better. We'll do it, like I said, another example coming up. Please subscribe to my channel. I hope you liked the video. If so, please hit the like button and continue to tune in. Thank you.